Welcome, investors. If you've checked your portfolio lately, you know the markets are in turmoil. This isn't just another week of ups and downs. Global politics, economic decisions, and corporate news are colliding all at once. Headlines warn of war, central banks are making big moves, and major Indian companies are in the spotlight. For investors, being informed is no longer optional, it's essential. What's different this week? The sheer number of high-impact events happening together. There's the threat of conflict between Israel and Iran, which could send oil prices soaring and shake the global economy. The US Federal Reserve just wrapped up a crucial meeting, and every word is being analyzed for clues about the future of money. At a G7 summit where world leaders are redrawing trade and tech lines, and you have a recipe for extreme volatility. For Indian investors, these global events aren't distant. They directly impact your wealth. When oil prices spike, costs rise for Indian companies and consumers. When the Fed changes its stance, foreign investors may pull money out of India, dragging our markets down. This week is a test of patience and strategy. The market is reacting to a complex web of information, not just one event. Our goal today: break down these major events and connect the dots between global headlines and your investments. Let's cut through the noise so you can navigate this turbulence with confidence. Let's get started. The biggest shock this week? Rising tensions between Israel and Iran. A conflict here isn't just regional, it's a global financial earthquake. The Middle East is vital for oil supply, and even the fear of war can send crude prices soaring. India, as a top oil importer, feels the pain immediately. Higher oil prices mean higher costs for companies and consumers. Sectors like airlines, paints, and logistics get squeezed, while your daily expenses rise. In times of crisis, investors rush to gold, a classic safe haven. So, while equities may bleed, gold can cushion your portfolio. Defense stocks and domestic oil producers might benefit as governments ramp up spending and oil prices rise. On the flip side, oil consumers, airlines, paints, FMCG, face margin pressure and stock declines. Understanding these sectoral impacts is crucial for repositioning your portfolio. War fears don't just move markets, they reshape them. Stay alert to which sectors are vulnerable and which could thrive. In turbulent times, smart allocation is your best defense. Don't just watch the headlines, act on them. Meanwhile, in Washington, the US Federal Reserve just held a key policy meeting. The Fed's decisions ripple across the globe, shaping everything from interest rates to stock flows. When the Fed hints at rate cuts, markets cheer. Cheaper money fuels growth and stock rallies. But if the Fed signals rates will stay high, foreign investors may pull money from India, seeking safer US returns. This selling can drag down everything from blue chips to small caps. Conversely, dovish signals from the Fed attract foreign money back to India, boosting our markets. The Fed's tone directly influences whether we see inflows or outflows. For Indian investors, tracking the Fed isn't about the US economy, it's about global capital flows. A hawkish Fed means caution, a dovish Fed means opportunity. Watch the Fed's words. They can move your portfolio as much as any local news. In today's world, global money moves at the speed of a tweet. Stay tuned to the Fed, because its decisions shape your returns. Understanding this link is key to navigating volatile markets. Don't ignore the world's most powerful central bank. Its next move could be your portfolio's turning point. Back home, Bajaj Finance is in the spotlight, with rumors of a bonus issue or stock split. With shares over Rs7000, a split or bonus could make them more affordable for retail investors. A stock split divides each share into smaller units, lowering the price per share but not changing your total investment value. A bonus issue gives you extra shares for free, again reducing the price per share. These moves don't change the company's fundamentals, they just make shares more accessible and can spark short-term excitement. For long-term investors, focus on Bajaj Finance's business quality, not just corporate actions. The real value comes from earnings growth, not from splits or bonuses. Don't get caught up in the hype, look at the fundamentals. While central banks grab headlines, the G7 summit in Italy is quietly shaping the future. Leaders from the world's top economies are discussing trade with China, the Ukraine war, and the green energy transition. The G7's push to diversify supply chains away from China is a huge opportunity for Indian manufacturing. Think electronics, chemicals, and pharma. Billions in green energy investments could accelerate India's solar and wind sectors, benefiting companies like Adani Green and Renew. Defense and IT firms also stand to gain from new partnerships and a stable global outlook. The G7's decisions can shift global fund flows and investor confidence. For Indian investors, these trends mean new opportunities and risks. Watch for policy shifts. They can create long-term winners. Global politics isn't just background noise, it's a driver of sectoral fortunes. Stay alert to these global currents. They shape tomorrow's market leaders. The Fed isn't the only central bank making waves. Japan, England, Switzerland, and Sweden are all announcing policy decisions. The Bank of Japan's potential rate hike could pull Japanese money back home, reducing global liquidity. The Bank of England is likely to hold rates, while Switzerland and Sweden may cut, signaling the start of a global easing cycle. Even small rate cuts can boost global liquidity, encouraging investors to take more risks. For India, these moves can mean more foreign inflows if global money seeks higher returns. The actions of these central banks set the tone for global markets. Don't just watch the Fed, track the whole cast. Their collective decisions shape the flow of money into emerging markets like India. Global liquidity trends can make or break a rally. Stay informed. These moves matter for your portfolio. So, what's next for the Nifty? Last week's 1% drop shows investors are already nervous. Geopolitical risks and Fed uncertainty are driving foreign investors to sell, putting pressure on our markets. Expect more volatility and a negative bias in the short term. Think of the market as a boat in a storm. Global shocks keep pushing it down. But India's economy remains a bright spot, with domestic investors providing stability. Systematic investment plans and mutual funds are cushioning the fall. Key data to watch: India's inflation and trade deficit, plus US retail sales. Lower inflation could give the RBI room to cut rates, a big positive. The market's direction will be a tug-of-war between global headwinds and domestic strength. Stay cautious, but don't lose sight of India's long-term growth story. Volatility is part of the journey. Focus on the fundamentals. Keep your eyes on both global cues and local resilience. In this market, selective stock picking is crucial. Don't just buy the index. Defense stocks, oil and gas producers, and public sector banks are likely to outperform thanks to global tensions and strong balance sheets. These sectors can act as defensive plays in a volatile market. On the flip side, oil consumers, airlines, paints, autos, FMCG, face rising costs and margin pressure. Be cautious with these sectors until oil prices stabilize. Higher global interest rates could also hurt real estate and infrastructure, which rely on borrowing. It is a mixed bag. Global slowdowns hurt demand, but a weaker rupee can boost earnings. Mid-caps and small caps have shown strength, but stick to companies with strong balance sheets and clear earnings visibility. Avoid speculative bets and focus on quality. The key is to know where the risks and opportunities lie. In turbulent times, sector selection matters more than ever. Protect your capital by being choosy. Let fundamentals guide your picks. So what should you do now? First, stay calm. Panic selling locks in losses. Markets move in cycles. Fear often creates the best long-term opportunities. Focus on preparation, not prediction. Review your asset allocation. Don't be overexposed to risky equities. Gold and debt instruments can cushion your portfolio. Keep some cash ready to buy quality stocks if markets fall further. Diversification is your best defense against volatility. Stick with fundamentally strong companies, low debt, steady profits, and a competitive edge. Continue your SIPs. Buying during downturns averages your cost and builds wealth. Don't try to time the market. Invest in stages if you have a lump sum. Stay informed, but don't obsess over every headline. Market turmoil is part of the journey. Discipline and patience pay off. Focus on quality, stay diversified, and keep a long-term view. That's how you survive and thrive in turbulent times.